Are ETFs a good investment? Yes. However, should you put all your money in them? Absolutely not. Stay tuned to find out why. ETFs. Now, what are they? Every guru, YouTuber, and even financial advisors and financial professionals are talking about them. From Tony Robbins to Robert Kiyosaki. Everybody is talking about what they are, but there's more to them than people know. In my personal years, I've also invested in them. However, there's a little more nuance to them that I really want to explain, and what could be some of the red flags. Now let's start off. Now, ETFs are exchange traded funds. They are passive investment funds that only hold the specific securities that the funds are designed for. You can easily buy and sell them like a stock on the open market, hence the term exchange traded. Now, they're basically a basket of securities, and the only investable way is once you buy it, they basically hold the securities that each fund is designed for, whether it's stocks or bonds or the S&P 500 index or financial sectors, tech sectors. They're generally diversified and they have much lower fees because they are passive investments. You just buy it and hold it for the long term, and there's no active trading happening in those funds. However, should you have all your money in them? Absolutely not. Now let's get into that. First off, okay, let's just think about Wall Street overall. Now, if ETFs were the be-all and end-all to investing, why haven't billionaire hedge fund managers just closed down their funds and put all their money in ETFs? And, just go on vacation, no need to work if that's the be-all and end-all. Why haven't, large banks and investment banks, why haven't they shut down their asset management divisions? Why hasn't Warren Buffett shut down Berkshire Hathaway, fire all his staff, and put all his money in ETFs? Now, there is truth over the past few years and over the past decade that there has been an outflow from active managed funds into ETFs and into more passive investments, but there's more to the story. If that was the be-all and end-all, then the entire industry should pretty much have been shut down by now, and everything would have gone to ETFs. But there's a couple of things that need to be discussed that most people don't really discuss. Now, these are valid questions, and they're ones that fund managers, both mutual funds and hedge funds, and almost all Wall Streeters know, because they could be problematic for several reasons. And we'll get into them right now. Now, the third reason, or least important reason. Now, most people think that ETFs are boring, and guess what? They are. Who have you ever heard, brag about that they invested in an ETF and got rich after 30 years? Now don't get me wrong, boring is good for certain type of investment strategies, such as my own in value investing. But the general feel of investment management, the general excitement of doing the work, the analysis, going over the financials, reading the charts, it's exciting. And so people often think that investors keep investing in people who work in active investing. A good amount of that is also for the excitement and the fulfillment of actually doing the work. Kind of like a person who would like to get into real estate would feel much more excitement of buying a rental property, fixing it up, renting it themselves, and reaping the rewards, rather than investing in a REIT, which is a real estate investment trust, which also trades like a stock, and it's a passive investment. It gives you exposure to real estate, but a person gets much more excitement from buying their first rental, and that's something that they could brag about, and that's really gets them going when they could maybe move on to a second rental. The general excitement of active investment management, of the trading, of the analysis, that's a thing that you really don't get with ETFs, and it is definitely a reason why people don't like to have all their money, and then people don't like them. Now that is the least amount of reasons, and we're coming up on the really two big ones. Is the bear market. Now, when the majority of the market goes down, almost all ETFs go down with it. A lot of these ETFs, the stock ones, they're diversified or specific sectors, but if the whole market is affected, they're all going down. I mean, look what happened in 2022. All ETFs went down. The S&P 500 lost, I believe, 19.5% over the year. Anybody who had the S&P 500 ETF lost 20%. And if you have a lot of money, and if you needed the money at some point maybe to retire within those years, you were pretty much looking at a bad year, because they're passive investment funds. So it's like you have to actively sell your shares for you to get out of the market. There's no active management, because the fund wouldn't sell maybe bad investments for you. They're there to mimic the return. If a company goes down in the S&P 500 or goes bankrupt, the fund is not there to take that money out. It's there to mimic it. So the bear market is the second biggest reason. And here we're going to get into the number one. Let's first think about the caveat here, right? So if everyone buys an ETF, like the famous S&P 500 ETFs, and everybody wants to mimic the S&P 500 return, right? Because apparently that's the best one, and that's the one that over the long term fund managers can't beat. But if everybody was investing in an S&P 500 ETF, then their funds would be used to buy shares in the companies of the S&P 500. So there would be a massive buying spree, which would then artificially raise the price of those companies and artificially inflate the S&P 500 index. Now, what happens when the price of a security is artificially propped up just in price and not in value from buying of the masses? It becomes a bubble, and it eventually will crash. And most ETFs that are, if they were propped up by a specific, just buying those securities, they will end up taking the brunt of losing the value. Think about the oldest story in investing. Think about the tulip bulb craze in the 1600s in the Netherlands. Imagine a tulip bulb, the seed of a flower, worth more than a house in Amsterdam, right? That's what happened there, and that's what could happen if everybody invested in the S&P 500 ETFs. It would become a bubble. It would be artificially propped up only by buying, not by value of the companies. And when those prices of those stocks and the entire index rises exponentially compared to the values that are not, then the companies wouldn't be worth what those the prices of those shares, and then sooner or later the bubble would pop and things would crash. And now I know what you're thinking. Wouldn't the crash just be a bear market that will eventually return? Well, not necessarily. It could take decades to regain the value. A lot of that happened in 2008. A lot of that happened during the tech bubble in the early 2000s as well. It could take a long time to actually regain the value, depending on how big the crash is. Some people never recovered, and that has happened from many crashes in the past few hundred years. But the main point is that if most average people are in ETFs, who will be the first ones to cash out when they recognize the bubble, or when the bubble starts to pop? It would be the hedge funds. It would be the mutual funds. It would be followed by, pension funds and college endowments. And then pretty soon the investment banks following them, because the investment banks also hold securities on their books, and they would, cash out when they can. You know, they will cash out and reap the rewards of the bubble. But the average person who's holding the S&P 500 ETF will be left holding the bag at negative returns, because passive investments only hold the stocks. They don't actively trade. You would have to recognize the bubble yourself, maybe read a little bit of news, and if you have all your life savings in them, go in and sell it to avoid the big crash. And most people won't do that. So that's definitely the biggest reason why a lot of people, most people don't have their money and shouldn't have their money all in ETFs. Now, the odds of this type of event occurring is more or less minimal, this type of crash. However, it is the reason that the investment management industry, the asset management industry as a whole exists and will continue to exist. Pretty much going on for a long time, because passive investments like ETF as a whole can cause bubbles, and they do not make money in bear markets. Only active investors like hedge funds and mutual funds more often than make money in bear markets, or at least minimize losses that end up being eaten up by these ETFs. Active managers may not beat the S&P 500 maybe in bull markets, but it is worth it to minimize the losses and bubbles in a bear market. And that's basically the three reasons. If I was to rehash them again, for one, it is because it's boring. Most people like excitement, so the industry will continue there. Bear markets, because the ETF will go down, and only active managers can really minimize their losses there. And three is because if it was the be all and end all, it would cause a bubble. Those companies would only be propped up by artificial buying, because everybody thinks it's the be all and end all. That's why Buffett hasn't shut Berkshire Hathaway down. That's why Jamie Dimon hasn't shut JP Morgan Asset Management division down. And that is why all these companies and investment management companies, Fidelity and them, they will continue to offer active fund management. And even though they may have seen some outflows, they've actually have seen in the past year, I believe from the 2022 bear market, they have seen inflows. Anyway, yes, those are the three reasons. Stay tuned for more videos. And again, this is the Millennial Net Worth. See you guys next time.